People are still trickling in, but we're going to get started. Good afternoon, everyone. My name is Andres Portilla. I'm Managing Director for Regulatory Affairs here at the IIF. We're very pleased today to lend our house. This is not really an IIF event, but we're very happy to host Fernando Fernandez here, who is going to tell us about the Eurobook, which is a publication that really goes into depth about Eurozone issues, the European architecture, including something that is very close to the IIF, which is the European Banking Union. A number of our members are very active in the region, and we have been very strong supporters of the European Banking Union, capital markets unions as well. So we thought this would be a good opportunity to sort of use the excuse of the book to then have a good dialogue around these issues. You have a program for the event today. So what we're going to do is to have Fernando to present the Eurobook 2018, which, by the way, has been sponsored by the Fundación de Estudios Financieros and Fundación ICO. And then for 20 minutes, Fernando is going to tell us about the main conclusions of the book. And then we have invited Mahmoud Pradhan, Deputy Director of the European Department at the IMF, to provide some commentary on the findings and conclusions of the book. And then we have asked Martin Boer, who's Director of Regulatory Affairs here at the IIF, to talk about the European Banking Union specifically. This was something that we also discussed at great length in Brussels not many days ago. Fernando was kind enough to be there with us as well. Logistically, after those interventions, we're going to open the session to Q&A, so please feel free to intervene and to opine and ask questions, hopefully tough questions, to our panelists. And I should also let you know that this event it's being recorded, and later on is going to be published. Fernando, you can tell us about it. So with that, let me pass it on to Fernando and welcome you, and very happy to host you here.
Well, thank you. Thank you, Andres. It's a pleasure to be here at the IIF. It's a pleasure for me to be back in Washington, where I used to work many years ago, and some of the friends, the faces here are familiar. As Andres was saying, well, first of all, thank you, Martin and Mahmoud, for agreeing to be discussions on the paper. Let me say from the beginning, to answer one of the questions Andres was saying, is this colloquium will be posted on the webpage of both of the sponsors of the report, the Fundación ICO and the Fundación de Estudios Financieros. As a way of, we've been doing this in different locations. The whole idea of the report, let me get straight into the report after thanking the IIF very dearly for helping us to sponsor this. This is the second time we present the report in the US. The whole idea of this report, this is a project that was started almost 8 years ago when the Euro crisis erupted. It was always conceived to be a one-year project, but the fact that we've done it for 8 consecutive years, it tells a lot about how banking union and the European Monetary Union has evolved. And I'm afraid to tell you that we have already been commissioned to do the same report for this year. So the assumption, at least in Europe, at least in Spain, is that the crisis will be with us for the peculiarities of the union will be with us for at least another year. As I said, the project had the dual purpose of being sponsored by both the Fundación ICO and Fundación de Estudios Financieros. The dual purpose of, one, explaining what the European Monetary Union is about. As you know, all of us who've been working in the European Monetary Union, it's a rather unknown animal, and people have very strange questions and comments on what the union is. People in Europe have very strange questions, not to mention people outside Europe. Let me tell you incidentally that my students at a business school in Madrid, who is supposed to be a prestigious one of very good students, the knowledge they have of the European Monetary Union amounts to zero. They have no idea whether it's a country, whether it's what does it mean that they have the same monetary policy. So that was the first purpose. Let's make the union known to a wider audience, to as wider audience as possible. The second one was, since this is a work in progress, since this is institutionally speaking, is something that needs to be developed. Let us. I have a presentation, by the way. Let us try to influence on what is going on. And in this idea, let us try to work from a Spanish perspective to make the monetary union to answer some of the Spanish preoccupations. And in doing that, with a very clear European perspective, to make sure that the EMU was both sustainable and stable. None of those things have been guaranteed yet. That's probably one of the main conclusions of the report. Now, the content of the yearbook is a rather typical one. It starts with an executive summary. Well, my role is selecting the topics, selecting the people. These are collective people. They're all kinds of Spanish economists, and not only Spanish, also Europeans and American economists, from all different fields, policymakers, academics, central bankers. For instance, I have the luxury this year in this report to have a paper by the current governor of the Bank of Spain, another one by a former Minister of Economy, another one by the current chairman of the Financial Stability Institute in Basel. So there's a large representation of people, and 2 or 3 people significant in the Spanish academia in economics. A couple of people from the bank, somebody from BBVA. My role there is getting all these people together, writing an executive summary, which is a very biased executive summary, because it first tells us what the different authors say on the different topics, and then disagrees with the authors and tells them why they are wrong. So to put it short, I give my own ideas based on some of the things that the authors write. I do this on purpose. One, because people who know me, and Angel was smiling here, I am a rather, I like to confront the issues directly. I'm not shy to express my opinions, but also because I think it's good on an issue that is evolving to give the reader the benefit of having different points of view on very conflictive issues. Angel, who has worked and written in one of the previous reports, we had a discussions on the Greek debt restructuring at the time. So we have never shied away from the most controversial issues. Now, this year's report is split in 3 different sections. The one is what I would call the European existential debate, or to put it in a different perspective, this is an unfinished business. What needs to be done to finish it? And that's where we have a report on the reforms that need to happen both in the macro structure, in the macro governance, and in banking union. And it also has an interesting paper on the need to have the European Union looking outwards, because one of the problems with the European Monetary Union is one of the problems with Europe in general is that we tend to look at ourselves too much and we forget that the world is moving and that we don't have the luxury of drafting the world that we would like to for the future. And therefore, there's a very interesting article by Alicia Garcia-Herrero, which some of you may know, on what the Asian perspective would be and what the Union needs to do, how to move ahead. So that's an interesting part. The second part is a comparative study on European Union monetary policy and the status of the financial system, the banking system in Europe. You will see there a lot of articles, first on the discussions on the ECB monetary policy. A discussion is ongoing, basically how to deal with the zero lower bound, all the things that I'm sure will come up in the discussion afterwards. But also it has a lot of data on descriptive statistics on the health, status, solvency, profitability, capillarity of the European banking system, comparing the different institutions. The main conclusion there is how different the banking landscape is in different European countries, how far we are from a sort of a stable, homogeneous banking landscape. And of course, there are articles there saying what needs to happen both in the regulatory, legal, or behavioral aspects. What banks need to do to really create a banking union. The question that section tried to address was this comment that I'm sure many of you have heard or made, is I will believe in the European Monetary Union where I see European banks, where I see real retail banks across Europe, which, by the way, we don't have yet. And the conclusion of the report is always still take some time before we have it, for the reasons that we can discuss later. Now, the third part is addressing the two main issues in the European monetary debate now, the issue of risk sharing versus risk reduction, and how to go about with that. And then, as is tradition in the report, we end up with the 10 European lessons of the year. So in this presentation, what I will do very briefly is to tell you, go quickly over on the history of the European Monetary Union, to say the design flows, and then some of the, to summarize the most significant reforms, and basically concentrate on what we learned. Let me start with three quotes from people you all know. The first one is by Romano Prodi. Romano Prodi is a character in European policy. He was President of the Commission, Minister of Economy and Finance, Professor of Economics, a very well-known figure in European politics, despite being Italian, by the way. And he wrote at some time in 2001, at the very beginning of the European Monetary Union, "I'm convinced the euro will force us to introduce a new set of instruments for economic policy. It is politically impossible to propose them now. But someday there will be a crisis and new policy tools will be implemented." So this addresses, I guess, three issues. First, we were not at all or totally stupid in Europe when we, in the Maastricht Treaty, we put in place a monetary union that we knew was incomplete and had design flows. We were not totally stupid. We did it because we thought it was the only way, one, to move forward, and second, because some of these design flows will be amended as we go on. This is what we would like to call the European process. You know, you create a problem and then you solve it. But if you don't create a problem, then you never solve it. So that was, this was known from the beginning. Now, what nobody anticipated, and certainly Romano Prodi didn't, is that it would take such a large, dramatic, and devastating crisis for the Europeans to realize that the banking union, the monetary union was imperfect, and second, that even today, there are still some design flows. The second quote is by Carmen Reinhardt, that I'm sure you all know. I had the privilege to work with her at some point. And she wrote in an article in Foreign Affairs in December 2018, very recently, "The first lesson of the financial crisis is how complacent policymakers had become." And this is something that we still have on the discussion. Our policymakers or central bankers in Europe are still very complacent. Our ministers of finance in Europe are still very complacent on the situation of the euro debt, for instance. Have we learned anything? The second point is even more interesting. The second, that a system of fixed exchange rates can turn into an economic straitjacket. So Carmen is asking the basic question, is the euro still today a system of fixed exchange rates? And if that is the case, how long will it last? The third quote comes from Larry Summers, who obviously needs no presentation today in here. And I was surprised to hear him in Sintra last year, not in this, Sintra like the Jackson Hole, tries to be the Jackson Hole of Europe, okay, the Conference of Monetary Affairs. Now, last year, Larry Summers was invited, and he made this quote, which I think it very much defines the situation today. Through history, we have seen countries without a central bank. But we have never before seen a central bank without a country. So I guess this is the basic question mark all Americans ask about the European Monetary Union. This was the question that they asked in 1996, where I was working here and the Monetary Union was already started. People were extremely skeptical, both in the academia and the policymaking area. All over what I would call American economies were very skeptical that this, one, made sense, second, could work. Now, 25 years later, it happened. It has worked reasonably well. It has stayed much longer than many people anticipated. It has reformed itself consistently to address some of the issues, but it still has some way to go. Okay, so let's quickly remember what we had in place, and I won't go into detail here. As you know, the Maastricht Treaty basically had three main pillars. One, independent monetary policy by the ECB, so it created an ECB which a very simple inflation rule. Second, national regulation and supervision of financial systems. So there was nothing in any way related or remotely related to a banking union. The idea was to have a monetary union and then banks will behave on its own. So there was no level playing field. Third, fiscal policies were national, but they were subject to three common rules. The Stability and Growth Pact, which basically tried to limit externalities, fiscal externalities on each other, that is limiting the fiscal deficit to make sure that nobody else would pay for it. Second, the famous no bailout clause. Third, the no exit clause. Now, of these three rules, the two of them have been overruled. The Stability and Growth Pact has been changed so many times that it's hard to recognize, and it certainly has not been a binding fiscal constraint on European ministers of finance. And if anybody here disagrees with that, I'm willing to take that issue, because it seems clearly to me that we have reformed it so many times in so many different ways. First of all, the presumption is it will be reformed if time comes and needs to be. Second, nobody pays too much attention to it, and the process is so convoluted that's not really a very binding restriction. The second, remember, for some time, the no bailout clause, for some time, the Germans, if I may say this abruptly, toyed around with the idea that we could get rid of Greece, that the no bailout clause would be enforced, strictly enforced, and then a country who could not live up to its responsibilities would be left out. And for 2 years, we were sort of thinking about, well, would it be better to let Greece out and then everybody else would work fine? We teach a lesson to those who do not behave, and the market will realize that this is serious, and then everything will be perfect. Now, after considering that, they decided to come back and bring Greece into the play. Why? Because the contagion issue became pervasive. By the way, the contagion issue is still here. So there was no reason to believe that if Greece is out, then some other country would be out, and then eventually France will be out, and by the end of the road, only Germany will be the monetary union. This is still an argument that is there. So, this was the Maastricht, how it was created, and surprisingly enough, it worked very well for 10 years. This couldn't work, but it worked. And it had to suffer a major banking financial crisis in the US for the European Monetary Union not to work. Basically, for the markets to become very aware of the risks involved in the process. They discovered that the king was naked. So what did the European Union, the Monetary Union did? Basically to change everything but the treaty in its name. So we are now in a European Monetary Union that has, and I'm sure there are many lawyers around that will disagree with me, that is only remotely related to the Maastricht Treaty in the way it works, and that has advanced significantly in many different areas that respond to Prodi's argument. And I've summarized these changes in the three basic case problems. For obvious reasons, I have not mentioned Spain here. It's obvious where I come from. But also because I do think it's not an example of anything, or of many other things. Greece is a fiscal issue, and therefore Greece puts in place the fiscal problem in the design of the European Monetary Union. And to make it short, it evidenced, one, an information problem that the European Monetary Union had on the fiscal situation of the countries. Now, how can you discipline countries that you have no idea what the real fiscal situation was? So that was solved. That was solved. We do now know what the situation is. Second, the fiscal policy externalities, but let me talk about the fiscal rules and its implementation. We discovered two things. One, that the fiscal rule was so loose that it was very hard to apply. And second, there was no way you could implement a rule that would sanction countries when they were misbehaving. When they were already facing major fiscal problems, then are we going to impose a fine on those countries to make sure that they don't perform fiscally forever? So the whole discussion on how to redraft the fiscal rule started with Greece. And then it also evidenced the fact that how do you help a country to stabilize itself when it suffers a major idiosyncratic shock if we do not have anything remotely related to a fiscal stabilization mechanism within the European Monetary Union. So it also Greece speaks about the need to create some sort of stabilization mechanism in EMU. Okay, so that's Greece. Then we have Ireland, and Ireland is a very typical example of a banking problem becoming a sovereign problem in a place, and raised very obvious questions. Now, how do you recapitalize banks without a central bank? Yes, it's a very funny question, but it's still with us. How do you recapitalize banks if you don't have a central bank? How do you recapitalize banks if you cannot create inflation? How do you recapitalize banks if you cannot print public debt to rescue those banks? So what do you do with the banks? You let them fall, you let them collapse, you let them go bankrupt. But then it so happens that these are the three major banks of the country. No country in its insanity would let the three major banks go bankrupt. So what the Irish did was what everybody would expect any Minister of Finance and any government to do: save the banks, and then go back to Brussels and say, "Here, guys, you have a problem." Now, how do we deal with this? That is how banking union started. After the Irish decided we will recapitalize the banks, forget about the rules. Now tell me, how do I do this orderly? But I've done it. And now let's face it, anybody will do it in the same situation. So this is the issue now. We have advanced significantly in banking union, creating first common supervision, common resolution. I will get that in a minute. And then we have Portugal, a country that many people would not put in the category of a typical crisis problem. I think Portugal is interesting because it's probably the issue that has not been resolved yet. How do you enforce growth on a country? How do you enforce the structural reforms in a country within a union, in a country that for many years, and this probably I should have drafted differently today than I did a couple of years ago, because Portugal has made significant reforms and significant advances in the last 2 years. But the question still remains: how do you enforce structural reforms? How do you make sure economic union goes pari passu with fiscal and monetary banking union? Or as I indicated in that slide, how do you induce competitiveness from abroad? How do you sweeten devaluations? Or let me ask you very directly, what do you do with the surplus balance of payment countries? What do you do with the structural problem in Italy? We'll go back to this in a minute. Okay, since then, the EMU has reformed itself dramatically. You probably know all this, so I will go very, very quickly. First of all, the ECB became as unconventional, as heterodox as any other central bank in the world, and therefore it became just a normal central bank. To extreme, by the way, and this is a point that I want to underline, not seen in the US, negative interest rates. And of course, this has some minor collateral effects. The main one, and it's a question of significant preoccupation in the European debate, in the European monetary debate today, is the possibility of an incoherence between the two main objectives of any central bank: monetary stability, that today translating in creating inflation at 2%, and financial stability, today translating in having banks that are both solvent and profitable. Being that highly unlikely with negative interest rates for a long period of time, now what is the ECB going to do is a significant question that is addressed, by the way, in the report. So that's back to the ECB. The ECB is normal except in a couple of things. One, it doesn't have normal means a normal central bank. One, it does not have a fiscal authority to dialogue or to discuss with. You cannot coordinate fiscal policy with a non-existent fiscal policy. The Eurozone does not have a fiscal stance, and that's an issue that is quasi-fiscal, but it also speaks to the peculiarity of the ECB. And second, it's probably the only central bank in a major advanced economy that runs monetary policy in an unknown paper that's certainly not the paper, neither of the ECB nor of the Union. It conducts monetary policy with subnational treasuries, if you wish. It's like the Fed conducting monetary policy with paper from Arkansas, Kansas, New York, and California, to some extent, because we do not have a safe European asset to conduct monetary policy. That's something that comes back and forth in the paper. So that's one thing. Second, in banking union, you know this very well, I won't get into detail. The single supervision mechanism was established in November 2014, if I'm not mistaken. What we do in the report is analyze how the SSM has performed in this year. And the bottom line is it has done extremely well, but there are too many question marks on the level playing field. There are still too many options, national options and discretions. It's not, we're still comparing apple and pears in banking issues, and there are still some questions asked. Now, the European resolution mechanism has started. We now have a mechanism and a fund that has been created. In the last European summit, the fund was partly, the European leaders addressed part of the issues dealing with the availability of funds in resolution by creating the backstop through the ESM, the European Stability Mechanism. Problem is you have a bank restructuring fund, which is backed up by an external European Stability Mechanism, which is not part of the same jurisdiction, which is an international treaty of its own, which requires unanimity of all the members, and which then makes any major banking restructuring decision to resolve in a major political role. And this is why I think despite what many people in Europe would think, that with the backstop for the fiscal, for the ESM to be the fiscal backstop for the European Resolution Fund, we have addressed one of the main issues. I still think we're a long way from being there. We have created a problem that if and when it has to be used, we will see how difficult it is to implement and how timely it takes, and therefore, by the time you want to resolve a bank, the bank will have disappeared. We were lucky enough that the first experience we had in Europe with resolving a bank, the Banco Popular, that most of you know, was resolved because there was what we call a white night. A white night, a private bank appeared at the very last minute, in the very 1 minute to midnight, and they decided to take on the cost of the bank. With no cost to the taxpayers. Now, that is never guaranteed, and we will come back to this issue in the discussion, I'm sure. Now, of course, the missing link in the European Banking Union is the European Deposit Insurance Scheme, where we still have made no progress whatsoever. And where still the language coming from the European leaders is this will have to take place pari passu with risk reduction, with reducing the exposure of European banks to sovereign debt. That is not happening quick enough, so there is no movement in it. Now, this is a very how shall I say this? This is a position that will, if not resolved soon, it will end up at some point in a major crisis, and the markets will at some point test which of those two conditions will give in first. Whether the European Union will have to put together a European deposit system in place in the midst of a crisis, which is very, in my view, you ask me, unfortunately likely, or if they will come up with some sort of enforced, enhanced, accelerated debt-reducing, sovereign debt-reducing mechanism for banks, which I think is extremely unlikely. But again, I'm willing to discuss this. Then on fiscal union, we've made significant progress, we mean in the European Union, but it's still limited in the sense that we have the fiscal rule, the Stability and Growth Pact, has been simplified somewhat, but also has been qualified so much that it really is very difficult to understand. The big, I guess, the consensus view certainly among the academics and probably also the policymakers in Europe, is that we need to significantly simplify the rule to make it politically acceptable to everyone, because it's transparent and it's unbiased. The problem with the rule is that nobody understands it, so it gives room to all sorts of political leverage in its interpretation, and therefore to the accusation of unfair treatment or excessively fair treatment, depending on the country to which the rule is applied. So I think the bottom line, and the paper makes a very good, the book makes a very good argument on this, we need a very simple fiscal rule that clearly is understood by everyone. Everyone meaning everyone, including those who are not economists, including politicians, and including the people at large. Now, of course, that will mean a trade-off between how perfect the rule is in being able to canvass the economic cycle, how simple it is. The more perfect we want to make the rule, the more complicated, the less understandable will be for the general public. The simpler the rule is, probably the less perfect it is to deal with the crisis, and therefore the more need for a fiscal stabilization fund to be able to complement the lack of capacity to adapt to the cycle of the fiscal rule. So that's how I think we should proceed on that. Now, the European semester, I don't want to get into detail here, but for those of you who are, there's this joke in Europe, there's only one guy in Europe, in the Commission, that understands the whole fiscal framework. And this guy is an Italian who is retiring in December, and therefore by January 2020, nobody will be able to understand the whole structure. And that is not far from true. I can tell you, I've been trying to understand, I'm not stupid completely. I've studied this issue for 8 years, and I still am not sure I understand all the complexities and vagaries of the European fiscal rule. Now, the European semester is basically a procedural structure which tries to use what I would call peer pressure, or to introduce peer pressure in fiscal policy in Europe. You know, we tell you you're not behaving. We hope that then you will realize that this is politically very costly, but then you will come back and tell us, will you behave a little bit? Then depending on how strong politically you are domestically, we will tell you go back and do your homework. We'll say, well, we cannot ask you more because this is as far as you can go given your political reality or given how large and significant you are in European issues, and therefore we might as well condone what you're doing. I'm not thinking of any particular country in this moment. And that, of course, cannot happen. At some point, we need to depoliticize the fiscal, or to completely politicize, meaning having a Minister of Finance in Europe which speaks for Europe and therefore applies fiscal policy, which is what the book argues for, by the way. So that brings me to the final point on this issue, and then I will skip, as I'm speaking too long, no? Yeah. On the macro imbalance procedure, the economic union, this is probably where we have made less progress compared to what, you know, it was designed or it was thought, it was envisaged at the time in the 2012. And this is the so-called macroeconomic imbalance procedure. You know, there's this big template, there's a lot of benchmarks, reports twice a year with no teeth. I mean, nothing has ever happened on the macroeconomic imbalance procedure for very good reasons, probably. First of all, because we do not agree at the technical level what this balance of payment surplus means. I mean, is that really bad? Or let me ask the question differently. How many countries in the world are aiming to reduce its balance of payment surplus? What would be the argument you would make as an IMF vision or as an IIF consultant to a country telling them, you know, you have an excess surplus in your balance of payments, you should reduce it for the benefit of humankind? It's kind of difficult to make that argument, especially when they tell you, well, this is not my problem. I have a fiscal surplus, a BOP surplus, because you guys overspent and don't save enough. Now, if you save enough, then you would have the same fiscal BOP surplus I have. So, I mean, the economics of this are not simple, are not straightforward. That's why. The politics are very difficult, obviously, especially because one of the points that I always underline when talking about the monetary union is that you have to realize this is an asymmetric union. It's a very federal constitution. Everybody has one vote. But the practicality of it is that there is one country that if it decides to leave, then the union doesn't stay. You know, the only reason why there is a monetary union in Europe is because one country remains in the union. Everybody else can leave and the monetary union could remain. But there's one country that is obviously, and that gives a real de facto difference. And now it happens to be the country that has a BOP surplus. And the country, by the way, that refuses to move ahead in EDIs. So the whole issue is how do you buy in a country that has a peculiarity in its economic performance in Europe. So that's my comment on the macroeconomic imbalance procedure. Let me go to the last slide, and this is to all these issues. What are the main European lessons for the year actually there's two slides, one and then one political at the end, very quickly. So what are the main European lessons that the yearbook draws from all this discussion? First, the EU needs a political will to move forward and to look outward. You know, this may sound as a very, how shall I say this, unacademic or untechnical conclusion for a report of this kind, but let me remind you the European monetary union is a political process. And that's the thing that has to be understood first and foremost. If that is not understood, then there will be no point in discussing any further, because we all know it's not a perfect monetary zone, an optimal monetary currency area. That's obviously the case. But it is a political thing. Now, so the question now is, do we now have, with the new leadership in place, meaning the proposed new president of the ECB and the Commission, we will have a strong enough leadership to be able to move forward the agenda? And that's an open question. At the time the report was written, the answer to that question was clearly no, but we had no leadership. You know, it was a point where Macron and Merkel, who had been the leaders of Europe for obvious reasons, both of them seemed to be not in the best of their political life. And therefore, the question the report asked was, we do not have the political leadership to address these issues, and therefore we will not see major advances in the coming year, in 2019 and 20. Now, today, maybe the answer is different, and I'll be glad to hear your comment. Second, the ECB needs to normalize itself. It has to address two issues. If and when we come into a decelerating cycle, or if and when the European Monetary Union growth moderates and unemployment starts growing again, what is the room for maneuver of monetary policy? How negative can negative interest rates be? Where is the zero lower bound there? By the way, the report has a very interesting article on how the digital transformation can answer these issues. And there's an interesting article on how central bank digital currencies, what are the benefits, the pros and cons in monetary policy and in financial stability, that I would recommend you to read for those who are interested in the zero lower bound. Of course, this is the issue of, in a perfect digital world, negative, and with all individuals having a central bank account, then negative interest rates can be as negative as you wish. But this is the world we want to move forward to. So that's one point. And the potential conflicts of interest between monetary and financial stability that I mentioned before, that I underlined in the report. Third, the risk reduction strategy is necessary, but it's not enough, and for the wrong reasons. First of all, the reduction on sovereign debt exposures of banks is necessary to restore bank profitability. Not for the reason of reducing risk sharing among the European taxpayers. If anything, a monetary union is characterized by the fact that risk is shared among the different elements of the union. Imagine people in Arkansas questioning how exposed their banks are to sovereign bonds in New York. Does that make any sense? Now, of course, I know we're talking about a central bank without a country. That's the whole issue here. But the point I'm making is, I don't know of any jurisdiction in the world that is mandatorily limiting the exposure of their banks to their own sovereign. And therefore, I think this is a non-starter issue, but then we'll go back to this. But at the same time, it is necessary to continue reducing the level of non-performing loans in European banks, and certainly the level of idiosyncratic sovereign exposure. Completing banking union is urgent, and in particular it is. And I think the book argues for a timetable for its implementation. I think with this, it's the same we have the same problem we faced with the monetary union or with the European stability mechanism. What is important, what is urgent, is to have an agreed timetable for its implementation. It's not necessary that the implementation starts tomorrow. It's that we have a concrete, definite, no back possible on that date for the implementation. Because the assumption will always be in the markets, as it has always been in European issues, that if need be, that date will be advanced. We'll move forward if there is a crisis. But we do need that date. That's the only way, and I put it very simply, that is the only way for a euro to be the same asset regardless of where it is deposited. Meaning the euro is the same asset deposited in a good Spanish bank, of which there are some, an asset of the same quality as the same euro deposited in a bad German bank, of which there are also some. But today, that euro deposited in a bad German bank is an asset of higher quality than if it is deposited in a good Spanish bank. And the only way to deal with this issue is having a European deposit insurance system. And unless we face this, we will always be confronting the issue of any potential sovereign problem becoming a banking problem, and a banking problem become a sovereign problem, and this will be in this doom loop in which the European economic policy has been for the last 10 years. So completing banking union is urgent. We also need, by the way, appointed people that we made in the report I haven't talked about. This is, let me take 30 seconds here. Why don't we have European banks? And there are many answers to this. The report makes two, I wouldn't say new, but interesting arguments. One, we don't have European banks. Well, obviously, because you cannot manage liquidity in a European perspective. And therefore, there's not an advantage for having a European bank. banks are still subject to national restrictions in the use of the liquidity in their sovereign and capital rules, etc., and therefore, they don't see much of the work. But second, and more important, because there may be an excess banking capacity in the European Union. Therefore, we have excess banks. It's very difficult to do M&As, especially if over 50% of European banks are not subject to market forces, are banks that are protected by their special status. And of course, I'm talking about the so-called Landesbanken, Sparkassen, etc., with the authority that gives me the fact that we had that problem in Spain and we resolved it dramatically to the point where now almost 90% of the Spanish banking system is 87%, if I'm not wrong, is subject to the direct ECB rule, and all of it subject to market forces. Now, how are you going to create large European banks if a significant part of the European banking system is not subject to the market and therefore doesn't respond to the basic profit concerns? So that's an important point, I think, that the paper makes. And how do you remove obstacles for that? What needs to happen in order to have, because there's, I see the ECB taking too much time saying, banks are not profitable, they should merge. Now the question is why they don't, and what you should do as a monetary authority to make sure the bank. And then, last point is strengthening the fiscal union. It's about simple enforceable fiscal rules, building and managing a fiscal stabilization capacity, creating a safe asset for the euro area and a euro treasury to manage it, and then and only then establishing an orderly procedure for subnational credit events. I hear too many people talking too early in the process about how do we manage the so-called subnational credit events, that is sovereign debt of sovereign states in Europe, in the movement toward Europe. I think this will only be possible to be addressed after we have a European safe asset. So the sooner we introduce the European safe asset, the better. Now, of course, all this leads to a closer political union. Of course, Larry Summers is right. Of course, the European monetary union is a wild, strange animal because we do have a central bank without a political union. But mind you, the whole idea was that at some point we would work towards creating a stronger political union and therefore a stronger process of transferring of sovereignty from current member states to the European Union. Now, the question really on the table is this the right political time? Do we have the right political leadership? This is how the question is typically framed. The way I frame it is, do we in Europe think that the markets will give us enough time that will give us the privilege to decide the timing on where to move towards further transfer of sovereignty, because they will be so nice to wait for our political realities before they decide to test the European Monetary Union again. As long as everything is perfect, everybody is fine, and every ship is afloat. If things get a little not so nice in the European financial, in the world financial architecture, is the European banking union today able to withstand the next crisis? That's my question. And the bottom line answer for the report is, with the current structure, no. But we are confident, and since we've moved so far, so rapidly, we will be able to move the necessary additional steps before it's too late. Okay, thank you, and sorry for taking so much time. But I hope this doesn't stop the discussion from being overly critic with the report, and this is the whole purpose.
Thank you. And, let me. Okay. Thank you, and thank you for the invitation. Let me start out by saying a few words of introduction. I've worked on the euro area at the IMF for the last 8 years, and my colleagues often think have already been subject to regulatory capture. Right, they are. But I start out with a very constructive attitude, meaning, what do I mean by that? That yes, we recognize numerous challenges, numerous imperfections in the architecture, but our mindset has always been to see how you can incrementally, and I want to emphasize that word repeatedly, incrementally improve. There are no big game-changing kind of architecture measures that I think will happen in Europe in any kind of immediate time, including responding to future crises and so on. But I'll elaborate on that. I agree with so much of what you say, Fernando, and so much of what is in the report, which I would really recommend you to read for those who are interested in the details, that I'm only going to focus my remarks in a few minutes on a few issues. And it may not be in any particular order, but I want to respond to things that you've said. I want to start out by talking about this idea of a safe asset. Okay? I think as economists, and when we look around the world and the US or other jurisdictions, we all kind of very easily convince ourselves that Europe lacks this and it needs it. Okay? I want to be really careful in two aspects. One is that the discussion in Europe about the safe asset, if I go back to 2010, 11, 12, the height of the crisis, whatever, there were a lot of proposals about Eurobonds, debt redemption funds, blue bond, red bonds, and some of you will be familiar with a lot of those proposals. All of those proposals had a common factor, which was it involved some kind of mutualization of debt. It involved some sort of joint and several liability in the legal jargon, right? Something like an ESM. There is clearly, even now, no appetite, no political support in Europe for such a type of instrument, okay, for mutualization. My fear is that as a result of that, there have been many very, very clever economists who've designed all kinds of other ways of generating a safe asset. Okay? SBBS is just one example. The Commission has a recent other example. Okay? I really wonder whether any of this is going to go anywhere in terms of creating this safe asset. Okay? SBBS would be a good example. The latest Commission proposal, and I'm not going to go into the details, but it requires countries to accept that some portion of their debt will be issued as junior debt. Now that, I think, is a complete non-starter. Okay? I can give you one example. When we asked the French Treasury if they would ever consider issuing a junior bond, I mean, the answer was a blanket no. For 300 years we have been fine. Why would you ever expect us to, and this is France, so think about it elsewhere. So that, now, what are the implications of that? And I want to kind of, because in terms of practical proposals of furthering risk sharing, and I want to relate it to the capital market union, I know you report on it very well, and one of the Spanish central bank governor is a great champion of that. We, by the way, very soon will be issuing our analysis on how to move the capital markets union forward. I can advertise the date. It's September 10th in Brussels. But many people, and I'll take one example, Vito Constancio, for example, has made a very strong argument that you can't have a capital market union without a safe asset. Okay? And there are others reporting that. While we don't fundamentally disagree with that, we think that stance would actually delay some of the steps that are necessary to advance a capital market union which do not require a safe asset. Where the end result is a completely integrated capital market union, whether that needs a safe asset and we may not get to the end goal, I think that's something that we can wait. But we should not let kind of some simple progress on the capital markets union be hampered by this other requirement, because the political economy of a safe asset is very, very difficult at this point. What I mean by that is, in a capital market union, for example, what is the kind of fundamental need for a capital market union? And it's very, very simple. The EU has made phenomenal progress in the single market for goods and services. Okay, still not enough in services, and the Services Directive hasn't been implemented at the national level. There are lots of resistance and so on. That's a big gap, the Services Directive. But it's made a lot of progress on that. On a capital market, if you look at the dispersion in the cost of capital to the real sector across Europe, that is quite a stark reminder of the incomplete monetary union. And I think you point to that. Does that require a safe asset? And our answer will be no. That does not require a safe asset. There's no reason why Italian firms or Austrian firms of similar creditworthiness characteristic sectors should pay such a different cost of capital. We can use examples of Spanish firms versus German firms, and we'll show you some results in our paper. A pan-European integrated capital market is really a vehicle to promote convergence, to even out the cost of capital for the real sector, whether it's households, corporations, etc. This also requires a pan-European supply of capital. For example, the Commission's recent proposal to try and find a way of making a pan-European pension product. Okay, these are very good to make the supply of capital a pan-European kind of base. And there are sort of Brexit dimensions to that I don't want to go into that at this point. I'm going to leave my remarks on monetary policy till the end. Let me focus on the capital union. On the banking union now. Some of the things you said. I think it is very unfortunate, and I agree with you on many things you say in the report, that the risk reduction versus risk sharing debate, the goalposts have constantly been moved. Okay? And this is unfortunate. This is where Europe lacks progress, and everything you said about EDIS, we're full subscribers to that. There has been very substantial risk reduction, if I look at the last, since the crisis in the European banking sector, through various channels, right? The latest banking package adopted in December by the Eurogroup and subsequently by the leaders in their summit is another kind of installment of that risk reduction process. But on risk sharing, there is very, very little progress, and EDIS, there is close to zero progress. This is a big problem for the banking union. Another dimension of the banking union, which is quite a unique venture in the following sense. Fernando, you talked about how rapid progress has been made, which we acknowledge. But another really unique feature of something like a banking union is that the industry, the banking industry across Europe, was very, very fully supportive of it. This is quite an unusual thing when you think about a policy initiative. Is the kind of constituency going to support or not? The reason why it was very supportive, and the reason why it's very disappointed, and if you talk to many large banks, they're extremely disappointed with the banking union, is they wanted the ability to move liquidity across borders. The banking union has not delivered that. For some of the reasons you talk about, the national ring fencing of liquidity and so on. So now we are left with a situation where, let's take a large bank, and I won't name names, but a large bank pays a large annual contribution to the Single Resolution Fund. Okay? Supposing over time, if we don't make further progress on the banking union, cross-border liquidity, supposing over time that large bank and similar other banks question, why are we making this contribution to the Single Resolution Fund? What do we get in return? Okay. We supported this venture because we liked the idea of cross-border capital flows, moving liquidity where we have excess liquidity in one jurisdiction to be able to move it to another place where we may have better asset opportunities and so on. I think that's a risk, and that's one way we urge of why further progress on banking union along the lines you talked about, so I won't go into the details, is really important. Let me touch on the backstop and some issues that you raised, and Bank Popular is one of them on the liquid. The backstop is an achievement, the fiscal backstop to the resolution fund. But I do not think it's a game changer. Okay? Supposing in the absence of a backstop, a fiscal backstop to the SRF, we faced a large banking crisis in Europe. What do we think would happen in practice? Okay. My guess would be the 19 ministers would get together on a Friday or Saturday, and on Monday they would have an answer. Okay. They would be forced to take recourse, which I think you're hinting at, right? In that sense, the backstop is not a game changer, okay, the fiscal backstop. And I completely agree with you. If we were faced with a couple of large banks under stress or under difficulty, the backstop would not be sufficient. There are questions about how timely and whether some parliaments have to be consulted and so on. Now we're going into the details. The second issue is, and we have done a lot of discussions and work on this, and this relates to Bank Popular, is the issue of liquidity in resolution. Okay, this doesn't exist at the moment. If, as a group of economists, we had to devise a system, it is so simple. Okay, you just have to look at how it's done in other national jurisdictions. Maybe I shouldn't have said so simple. Nothing is so simple in Europe, right? So that's and it's essentially all you need. Every European agency, whether you talk to the Commission, the Single Resolution Board, the SSM, will all say there's only one institution that can provide the liquidity, which is the ECB. Okay? I mean, again, a no-brainer. How does the ECB provide that? Why is the ECB resisting, not saying, of course, right? And the reason is that the ECB needs an indemnity by national governments to say that whatever loss you make in providing that liquidity in resolution, the amount you provide is not your loss, okay? Once the resolution is you're providing liquidity in resolution and it's against them. Whatever potential loss you make, the shareholders of the ECB will underwrite that loss, which is how it roughly happens in other jurisdictions, right? That politically is so difficult, okay, to get to, that we may actually get there by, unfortunately, by an accident or by a live case, okay, or a live large case or live two large cases or something, okay. So, but I don't think the issue fundamentally is that difficult. Let me remark a little bit on some of the things you talked about on the no bailout clause and some aspects of it. I think, and I'm going to use an example here, there are others, okay? There's a recent paper by 7 French and 7 German economists. One of their authors has just walked in. Nicola, that's, there may be other authors here. The one part of that paper, and I want to emphasize, I'm just using that as an example, there are others, right? Is this idea of trying to make the no bailout clause credible. I really worry about this whole venture of trying to make the no bailout clause credible, okay? In the absence of a full fiscal union, et cetera, which we don't have, right? Okay. I think there are incremental types of kind of processes to see whether you could impose a little bit more fiscal discipline, incentivize fiscal discipline in countries, but we're going too far and then sort of taking that to mean, do we need some kind of debt restructuring mechanism and so on. I think that is very, very dangerous, and we learned about that in some years back in that walk on the beach in Deauville, right? I want to say a little bit more about the fiscal rules. The IMF has probably been the biggest pain for the European Commission in always saying, please implement the fiscal rules in the SGP, et cetera, et cetera. So I fully on. But I want to emphasize that really, if you look at the 10, 12-year record of the SGP and assess that against the counterfactual, okay, then I think the SGP has done a great service. If you believe in the premise that a currency union needs fiscal rules, some fiscal rules, I fully agree with your points on simplification, which we've written on a lot, and I won't go into the details. But we have looked at over time what would have happened under various counterfactuals. And the SGP, as implemented with the leniency, the flexibility, etc., has done a better job than a no fiscal rules environment. So there has been some fiscal restraint or governments and so on. I just want to make sure that I would not agree on your one point about when you connected a fiscal stabilization capacity, on which we are very, very supportive. As many of you know, we have argued for a central fiscal capacity, as a currency union needs a macro stabilization tool. One can talk about the design and so on. But I would not connect that discussion with the discussion of things like Greece. Okay? Those are different things. If a country needs ESM support, official assistance under a program, etc., that's a different thing. So a central fiscal capacity is for idiosyncratic cyclical shocks. if you are facing a situation where you don't have market access or you cannot borrow from the markets or the cost of market borrowing is exorbitant, that's a different type of situation where you need some official assistance through agencies like the ESM. I'm going to come back to a topic that I listed. I want to just make a brief comment is on, I think you are a little bit, Fernando, too negative on, let me just say the BRRD, okay? But I mean more fundamentally, which is when you ask, like, how do you do bank recapitalization when you don't have a central bank, okay? I think perhaps you're going too far, and I would claim that even in, let me take the UK as an example, during the global financial crisis, okay? A country that had all the freedom of doing whatever solutions, none of these political constraints. What do you see in practice? What they do is they, of course, loosen monetary policy, cheapen up funding costs as much as possible very quickly for the financial sector and others. That kind of helps a little bit. They provide some guarantees on funding, guaranteeing also liabilities. But they also recapitalize banks, but that was the fiscal authority, okay? They put in money in I mean, same to the US is something similar, right? One can. So I'm not too worried about the fact that the ECB doesn't have a recapitalization tool itself. That would have to come from somewhere else, okay? I don't think the BRRD is that different from the trends we have seen in other jurisdictions outside of Europe about the principles of what it's trying to achieve, which is to limit recourse to the public sector in the event of problems in banks. So burden sharing, bail-inable capital, we can argue about its kind of minor points in the implementation. Let me say my last remarks on monetary policy. And I just want to be very brief on that. By the way, we have just finished our Article 4, so I can't tell you too much until it comes out on Thursday. We will release the report on Thursday. Okay. But I'll tell you a little bit about how we're thinking about ECB monetary policy and at the current juncture, okay, given everything you all know, is that you really have to ask yourself, you can list down instruments that the ECB has if it needs to ease further or to be more accommodative than it is. You can list potential instruments. You then have to ask yourself, okay, in the event that you want to use these instruments, what's the mechanism by which they move the needle? And I use the word move the needle. Sometimes if I look at market commentary, maybe some official commentary, people are very, very focused on some measures of inflation expectations. For argument's sake, right now, five-year, the inflation swap. Okay. When I look at market commentary, my worry is that you see the ECB must do more. Clearly, inflation expectations are very low, subdued, etc., and we can have a debate about what's driving that. But I don't see any analysis of, if we use this particular measure, let's say whether it's asset purchases or restarting sovereign bond purchases or cutting interest rates, that it would move this needle. Of course, it might have some temporary effect, but is there any way you can say it has a durable effect? I'm not making an argument that the ECB should do nothing, but I just say it is really, really difficult at this point. If you've got over 60% of euro area debt, sovereign debt, trading in negative yield territory, what are you going to achieve by buying more assets? You can buy more assets by changing your rules or whatever you want to do. That's not the kind of, you can change your internally imposed constraints. But what will you achieve? Similarly, when I see market commentary on where negative interest rates can go, I really worry about, some calls of how far negative you can take them. If you, for example, took rates more negative, but then had to address some of the potential adverse effects on banks, and tiering is one idea or whatever. I mean, we're skeptical about what tiering will do for banks, but let's suppose that we're wrong and tiering is the answer. What are you going to do? How are you going to compensate the rest of the financial system that also is adversely affected possibly by negative interest rates? How do you find a way to compensate them? Is it only the banks that you care about? These are very live issues for policymakers, and I don't think there are some very simple answers for that. I think I'm going to stop there in the interest of time. I know we have promised people time to ask questions. Thank you. Sorry.
Thank you, Fernando. No problem. I wanted to say, Fernando, I very much enjoyed reading the book. Also, the 40-page executive summary, which you talked about, is very critical in a sense, but also it's critical.
That's what I expected.
It's quite a critical executive summary of the current state in Europe in 2018, but I think also very fair. And I think that you wrote it also in a very flourish style. So I think it's good reading. I'll just make a couple comments on banking union because we do want to allow some time for questions. I think it's notable that after Maastricht that we do have a single market for labor to some extent, although we've seen some hurdles recently. We have it for goods, sort of, and then for services hardly at all, right? And for some of the reasons that you mentioned. If you look at retail banks, they are largely domestic in Europe. There's been a lack of cross-border mergers. You mentioned Banque Populaire. I think it's notable that the only bank that bid on it is from the same country, is from Spain. So, and that's for lots of reasons. You can look at the lack of profitability, the fact that for a lot of European banks, their profits barely exceeds cost of capital. You can say that might be because of low interest rates. It could be because Europe is overbanked in some countries, but there's a lot of reasons for this. And so we're not seeing a single market happening. And then the regulation, as you say, if there's a bank in the Netherlands which has excess household savings, it's very hard to deploy that into German mortgages because there are liquidity rules and things like that. So you have to be fully subsidiarized in different countries. So there is no single market. So why is that? So and then you have the banking union. The banking union, I would be a bit more. I'd be a bit more generous in terms of the first pillar, the single supervisory mechanism. I think that it's only 5 years old. And if we look at the raised volume and quality of liquidity and capital, if we look at the reduction in NPLs, if we look at the more consistent supervision, the fact that European banks are now more comparable, more transparent, I think the SSM has really gone a very long way already, and it is just 5 years old, as you said. The second pillar, I think the SRB is up and running, it's strong, it's a credible counterpart to the FDIC and to other jurisdictions, but it's largely untested, right? We haven't really seen the SRB having to come in. The Single Resolution Fund, as you mentioned, the fiscal backstop, there's a lack of liquidity there. There's only about euro 60 billion at the moment to draw on to restore solvency and liquidity, but over time that's supposed to scale up. So there's hopes there too. On EDIS, obviously the third one, I agree with everything that you both said. Obviously the richer member states feel that if their deposit insurance schemes are full, why should they have to subsidize other countries since there's no fiscal union? So that's a very big political problem, and we saw just 2 weeks ago in Council and in ECOFIN that they're not getting anywhere with that. So I agree with you, if there is a financial crisis, then that's going to be a big issue. I do wonder what it means for the European Monetary Union with the UK leaving. So you have the largest out is actually leaving, right? So you have the 19 ins and then you have the outs, and so will more of the outs feel that they have to join? What about the fact that a Swedish bank moved its headquarters into Finland so it could fall under the SSM? So I think there's also, if you look at the deepening versus widening debate, we're also seeing a sort of deepening happening rather than the widening, right? Towards EMU, towards EBU. And then finally, just on capital markets union, to us, they are mutually reinforcing, right? Banking integration is a precursor to capital markets union. And I think I think it's obvious that the only two capital markets at the moment in Europe are in London and in Zurich. So that's a big problem for the EU going forward. So we have advocated, as have our members, for creating a European banking insolvency regime, which is currently at the national level rather than the resolution regime, which is at EU level. There should be a stronger securitization market. I know it's a bugaboo in Europe, it's much more accepted here, but it would be very good in helping banks offload assets. There should be a secure asset in the euro area, whether that's a euro bond or something else. So those are all things that we think would help. But we do want to leave time for questions, so I'm going to hand it back to Andres.
Thank you, Fernando, Mahmoud, and Martin. We have limited time, so what I'm going to ask is, I'm going to collect probably 2 or 3 questions, and then the panelists respond, and then we do another round as necessary. So let me, Angel.
So two of them. One is, first of all, I like it very much. Second, I think we have an example of when the euro area had a de facto fiscal union, and this goes for the two of you. It was 98 to 2007. There was the belief that there was full solidarity, spreads were zero, and there was the belief that no country would default. So there was the belief that there was a fiscal union de facto, obviously not de jure. What did we see there? Target 2 balances were zero, cross-border flows were there, and there were even cross-border M&As or attempts. Therefore, I want to make the point that a fiscal union de facto or de jure is a necessary condition to have a capital markets union and banking union, because, I mean, it makes sense, but we also have an example from the past. Now, second point. Let me capitulate and agree with you, we'll never have Eurobonds. So how do we create Eurobonds if we will not have Eurobonds? I have a simple quote unquote, never in our professional lifetimes. Why are...
Mine is shorter than yours.
Why are sovereign... why are bonds not safe today, right? One of the reasons is that the ECB does QE with capital key, non-share risk, and limits. And there are also rating limits to the bonds that the ECB can buy. So let me give you a solution. The Governing Council meets and says there will be no ratings limits to the sovereign bonds we can buy. Therefore, there is no problem for going below investment grade. No central bank does that, by the way. So this would be one way. And then you do QE under market weights, you explicitly share the risk, and you get rid of the exposure limits or the issue limits, right? In that case, all sovereign bonds are safe. And then you can have a de facto fiscal union or safe asset in the sense that bonds will behave like bonds rather than credit when the economy deteriorates. So what do you think about those two? Now I made it a question.
Let me collect 1 or 2, please.
I'm Miquel Otero from the European Commission. I have a question. We have been talking about, among other issues, on the banking union and the debate between risk sharing and risk reduction, and it's obvious that this is one missing part, no? And there have been a Commission proposal that was revised. There have been also long talks within the EU. So we'd like to check your views if there is any missing element that would have been included, would be included in the future, to make this really advance further, apart from the suggested timeline of the report.
A quick question on you. One of the 2018 takeaways were the ECB should normalize itself, and I'm not sure exactly what you mean. Should normalize the stance of monetary policy, meaning getting rid of negative rates, normalize the size of the balance sheet. I'm not sure, at least based on market pricing, for the foreseeable future rates are going to stay below zero.
Can I make some very quick comments on what you said before? Am I allowed? Just 3 very quick comments on what Mahmoud said. Professor, thank you. It was very, very, very interesting, both of you. Very quick. On Capital Markets Union, yeah, I fully agree with what you said. In fact, there was a slide here that I skipped over. What you see, the big difference in the stability elements or the risk-sharing mechanisms between the euro area and other federal states, the US, Canada, or Germany, is the size of the blue side. The size of the blue side is the size of how important are capital markets in sharing risks within the union. Okay, so I fully agree. Now the point, and this goes to something you said, Martin, too, one of the things that is crucial to me in that area, and it was mentioned somewhere before, is the idea to have a European insolvency mechanism. That is extraordinarily important to be able to move forward in capital markets union. The second also has to do with making sure that the regulatory field in Europe does not treat cross-border risk as being a different element of risk. So it makes no sense that, to put it in very easy words, a loan from a Spanish bank to a German company is treated in terms of capital requirements and solvency provisions just as a loan from the same Spanish bank to an Argentinian company. Ceteris paribus, the quality of the creditor, obviously. Now, that makes no sense in a banking union, and that's also why banks cannot act European-wise. So I think it's very important. It's a very easy thing. I fully agree, Mahmoud, and I'm extremely worried about this idea of trying that. I'm sorry, Nicola, of making the bailout clause credible. I think this is the easiest way for the European Monetary Union to explode. If we make the bailout clause credible, then it will happen, and then it will only have one member, Germany. Everybody else will use the bailout clause at some point. So, but anyway, that's just to enforce this point. Now, on the, you were very critical of my comments on the bigger RRDs, and I was very negative. Now, the only point I am mildly negative. I mean, let me say this from the beginning. You know, have I been told 10 years ago that this is where the European Monetary Union would be in 2019, I would have said, please don't drink that much. I would have never dreamed that the European Monetary Union would have moved forward this much in 10 years. But it's also a fact that we have never expected the markets to behave so widely in these years and the crisis to become so pervasive. So yes, the European Monetary Union has moved forward, but the conditions made it move forward. Now, on the BRD, the point I was making is, and I stand for this point, is I don't think, as far as I know, the European Monetary Union is the only jurisdiction that publicly states in law there will be no public money to recapitalize the banks. That will not happen, and you said it yourself. If need be, at some point there will be public money in recapitalizing banks. There is no way the ESM, nor the backstop, nor any sufficiently funded European restructuring fund will have enough capacity to deal with two major banks. By the way, we may have one example of that much sooner than we would love to. So, you know, that's just the way the market goes. That's, you know, so I think this is the type of things that we, you know, in Europe, I think we've overdone with the EBRD. That was the point. Now, the point I fully agree comes back to some of the questions somebody mentioned, that you mentioned here, is I think we should learn a couple of lessons from the past. And one is that to try to solve the issue of the euro debt with with a safe asset, with financial engineering, is just a concession to our ego as economists. There is no way any amount of financial engineering will solve the basic issue that a safe asset is only safe when it has the full power of the state behind that asset. And the full power of the state is the full power of the European taxpayer. Anything else is just, and allow me to say this very bluntly, an example of our ego as a profession, a particular financial economist. So I think this is something we should take into consideration. Now, on the question, Angel, I fully agree with you. A fiscal union is a de facto is a banking union, and the only way to have a fully banking union is to have a de facto fiscal union. The problem is now, because we had one, and because it proved not to be the reality of the matter, how do we reconstruct the expectations and the belief in the market that is a de facto fiscal union, especially because in these 10 years, a lot of political declarations have happened to make sure the fiscal union never happens. So the question is, how do we build now a de jure fiscal union is important. But I agree, theoretically. I don't agree with this idea that we will not have Eurobonds in our life. in our professional lives, because then I will have to conclude that we will see the collapse of the European Monetary Union in our professional life. And I'm not willing to admit, maybe because I'm too optimist at the end, that I will see the collapse of the European Monetary Union in the immediate future. And I'm sure that at some point we will have a crisis that will force the European Monetary Union to put up a safe asset. I hope it doesn't happen in my professional life. I'm not willing to bet that it doesn't happen in my professional life. So I think this is important. Now, on Fabio, on the issue that the ECB should reinvent itself, should normalize itself, my point was institutional-wise, not just for the policy. No central bank in the world is doing normal policy, monetary policy today. I don't think the ECB can do. I think the ECB has come personally to an extraordinary extreme, and I would build on something Mahmoud said, probably not with the same level of strength or passion that I will put in my words, but I do think that the ECB, the sooner the ECB and some other central banks, Fed included, realize that they will not be able to create inflation, that they will not be able to create inflation expectations in the immediate future, the better. The sooner we realize that the deflationary scenario has nothing to do with monetary policy, and no monetary policy will change it, the better for the central banks, which, by the way, are putting themselves in a very strong position, in a very difficult, awkward, politically loaded position, to be their independence to be questioned, because their promise is something they cannot deliver, and therefore, they being the only game in town, people will make them responsible, and it's not an accident that everybody is very happy in the financial community, because for the first time, and I'll quote again Larry Summers, we have somebody being proposed, and allow me this very politically incorrect comment, somebody has been proposed to be the chairman of the ECB who feels much more comfortable being a member of the European Council or the European Commission than with the colleagues in the European Central Bank, because the experience, their attitude, the thing, and this is Larry Summers saying this, by the way, it's not only me. It's Larry Summers in written today, and if you want me, I can show you the code. And I think I fully agree with that. But it speaks to the fact that the central banks around the world and the ECB have become too politicized. And they have become politicized because they have promised something they cannot deliver, but they have put themselves in the position that they've told the world we will solve this issue. There's a limit to that. That's what I want. Now, in terms of renormalizing institutions, what I wanted to say, in the paper is we need to have something as normal as a fiscal counterpart. Any central bank in the world talks to some fiscal institution, fiscal authority. Now, the ECB needs, the European Union needs some sort of fiscal council. The Fiscal Stability Board, by the way, which was created, I don't know how many of you know of its existence. The fact that probably most of you don't know speaks of itself. It's a non-existent body for all practical purposes. With all due respect for the members of the board, they're friends of mine, some of them, they're very competent, very elegant, very intelligent people, but it has no teeth. It doesn't speak for it. And I think it has to be addressed. We need to normalize that. And we also need to normalize the fact that you need a euro asset.
Very good. We should hear more questions, but just say, on BRRD, I know it's early days and we may see public capital. I'm not dismissing that at all, but both the precautionary recap and the systemic exemption, ill-defined as it is, do have the avenue for public money in large events. My comment on Angel's point, you may describe pre-2008 as that we had a fiscal union. We have no institutional mechanism for fiscal transfers, which I think a fiscal union, you need some minimal thing. We didn't have that. The fact that pre-2008 yields converged, et cetera, there may be other explanations for that, but I would not go as far as to describe that period as having a fiscal union. Your specific idea about if the ECB went market weight, et cetera, I do not think that a safe asset, either as economists, it's wise to create a safe asset by the ECB underwriting every sovereign debt. I mean, I think that's not the way to create a safe asset. Secondly, I would go nearer Fernando's view that ultimately, if you want a safe asset, it has to have a European taxpayer behind, which is, I think, your point, right? Because you may come across a period when, let's say, policy normalizes and the ECB is not buying anything. Is the market going to be just comfortable treating every sovereign bond as safe because they have this, the ECB has an institutional mechanism to buy, because the ECB is buying for policy reasons, it's not buying for other reasons, right? And I think that's it. I'll let others. Nicola, you want to?
Well, I arrived late and I apologize for this and I missed most of the action, but you kind of triggered the debate on this report that a number of us co-signed 18 months ago, and the point about the no bailout clause. So I just wanted to make a very simple point about this. Well, 2 points. One is what the crisis has revealed as the central engine of destabilization of the Eurozone is the bank sovereign vicious circle. And it's been discovered collectively, hadn't been predicted by the academic literature, but at the end of the day, that's what nearly broke the Eurozone in mid-2012. And by framing it that way, the heads of state and government created the banking union, enabled the OMT, enabled whatever it takes, and turned the corner. I think the IMF has to be given a lot of credit for helping the realization of how central the bank sovereign vicious circle was in the dynamic of the crisis, but we shouldn't forget that lesson. The second point is default did happen. With all due respect to Jean-Claude Trichet, who is my chairman at Bruegel, it's no longer credible to say there is no such thing as a sovereign default in the Eurozone, because it happened. It was in Greece, and you could even say there was a credit event in Cyprus, but let's leave that aside. The Greek default is a precedent, and everybody has it in mind. So pretending that defaults don't happen is not going to change a thing in the market perception. So if you combine those two together, the objective of policy should be to break the bank sovereign vicious circle with the awareness that defaults can happen and banking crises can happen. And I think that is what frames the policy agenda.
I wanted to ask a related question, but more on the financial stability and foreign policy. You know, the European banks are now more dependent on the swap lines, or sort of the dollar funding, than even before the global financial crisis. The Fed provided the swap lines because the crisis originated in the U.S. You know, if the crisis were to originate from outside the U.S., what would be the legitimacy of the Fed to reopen that swap lines potentially? And then the second question, related question, is sort of the reluctance of the ECB to sign up to the swap lines for the countries as well. So how do you think about it? Sorry, for example, yes, yeah. How do you think about those financial stability issues?
I'm going to take that question, but I'm going to ask Fabio for some help. He's the expert on dollar swap lines. But I'll take the kind of slightly simple question. I think ultimately, your question is a good one, and it really depends on, let's say the European banks, we have some other event and the European banks have an acute shortage of dollars. Okay. Is it in the Fed's interest to accommodate that via an ECB swap line or not? And I would just leave it at that. I don't think the answer to my mind is always it would not be in the Fed's interest. I think it depends on the kind of event we face. It may well be like it was in 2008. Okay. It could well be in the Fed's interest to accommodate that acute shortage. I think, like the Fed, the ECB has something similar considerations about extending swap lines too far. As you know, in the 2008, there were some countries, Korea was one, for example, that got a swap line. There were some countries outside the main G3 or whatever. From all I understand is the Fed is not willing to keep those permanently in place and kind of put that was a one-off crisis measure. And to my mind, I think a lot of banks outside of Europe, but in other regions, have learned to live without that sort of dollar backstop, if you want to call it that. But Fabio is our expert on this, so I don't want to say too much.
I mean, ultimately it's an FOMC decision. So they can make their own calculation, judgment, and decide what they want to do. I think as long as it's a systemic story, I think politically it's easier for them to do it because you link it back to financial stability in the U.S. If the dollar drawing is because or in a specific jurisdiction there is a specific large institution that needs a lot of dollars, I think politically it's much more difficult for that to hide behind, I'm just facing, say, the ECB.
Let me just add here that although we don't explicitly mention that in the report, I think I would take Mahmoud's word. I think it's very difficult to envisage a situation where the Fed would not consider it in its interest to come to the rescue of the European banking system in desperate need, short of dollars. So I would imagine that, or my guess would be, despite of what the actual arrangement would be, we would again see a rush to create the necessary arrangements. But the interesting point, in my view, what you were asking here is, we've talked a lot about the European Monetary Union because this is the purpose of the report of our yearbook. But of course, there is the bigger issue of international monetary coordination or economic coordination, which is an interesting one of its own. And unfortunately, I have not only barely touched upon that on the report. And this is an increasingly complicated issue because one of the things that we do say in the report is that some of the regulation regarding banks in Europe, some of the decisions taken by the European Banking Authority and the ECB, concretely speaking in terms of the MREL, go not in a parallel way as the TLAC goes. So building, strengthening the ability of banks to deal with foreseeable problems has taken a different route in the international U.S. arena and that in the European one. And that, as you know, is also creating significant problems for some of the larger European systemic banks, which have to comply with rules that are not necessarily compatible. And this is a point that we do make, and it speaks to some of the points, I think, Martin, that you mentioned, that I take a little skeptical view on the SSM. I think that which I was surprised, by the way, because if anything, I've been criticized for being too soft on the SSM. But fine. I think that there are two problems that I would underline with the way the SSM has worked. And one is particularly the lack of international coordination. This trend in Europe, because of the complexity of the international the internal discussions and the very different jurisdictions, the political motivated regulations, and at the end of the game, it responds to the legacy of the industry, the banking industry you receive. Not enough attention has been paid to international coordination in some issues. And the other point that I think I've been a little critic on the SSM is this idea of how totally irrespective of the time, effort, and money its practice is imposing on private banks. If you talk to any private bank, to any commercial bank in Europe, the first thing they would tell you is, could these guys cool it down a little bit? I mean, could they, first of all, agree among themselves and make sure that they ask the same papers from the EBA, the EBA, the ECB, now the European Resolution Authority? Could they agree on what they want? Could they ask it at the same template, at the same date? With this, these are minor issues, but when you talk to banks, these are not so minor. The only people that has been hired in banks in Europe these days is compliance officers, as I'm sure is the case here. Now, one point on Nicola, because you mentioned Bruegel, and since I also sit on the scientific, no, but you did, and since I sit on the Scientific Council of Bruegel, one of the things I did not like about that paper, let me say this, and I will quote another Spanish sentence, is that, which is not a Bruegel paper, I know, but it was signed by many members in Bruegel, many prominent members of Bruegel. It is that it took the view, what I would call, of those who thought there was a bad idea from the beginning to enlarge the membership of the European Monetary Union. It clearly reflected that thinking. Had the European Monetary Union membership been restricted to those members that make it, then it would have sustained. I think this is wrong. and this is very problematic. And let me quote a former Spanish president of the government when talking about the entry into NATO. He was quoted as saying, "We should have think twice before joining it, but there's no question we cannot leave." So, de entrada no, o de entrada quizás, pero de salida no. No way. So that's my thinking with the EMU. I don't know whether at some point we shall rethink or we shall thought better who will have been admitted into the European Monetary Union. But that's water under the bridge. What I have no doubt is that if we leave the possibility open that the no bailout clause will result in some country being thrown out of the Union, then the Union will not be sustainable.
I'm sorry because I have to answer that. The paper is predicated on the notion that the policy framework should ensure that even in the case of sovereign default, there is no exit from the European Union. So you're mischaracterizing the paper. I'm sorry. I have read the paper. I have even signed it.
I'll send you a copy to Trump if you want.
I just want
I think you're talking about a different paper.
No. But anyway, we can talk about this later.
Nicola, I just want to say, also, I did not elaborate, and your response to my point is, I am not basically ruling out that you can have that restructuring of defaults or whatever, right? I agree with that. I mean, it's just, my worry is specifying ex-ante mechanisms, okay? Conceptually, that I think can be problematic, okay? But that's kind of, I fall back on the IMF's case-by-case approach, and I can explain that in more detail if you want, but that's a different issue.
Well, we promise you an interesting, heated exchange of views on these topics, and we have delivered. Please join me in thanking this excellent panel for here.